Alright, welcome back to the Taco Show, everyone. So, today we're going to do something a bit different and discuss something I've already posted, and that's how to understand annual reports. So, I'm going to break it down into four categories, simply the order you find them in most annual reports. Annual reports can be hundreds of pages long, so hopefully this helps explain everything. So, we're going to start with Director's Report, look at the Board of Directors, financial statements, and then lastly, any extra information which I think is important with annual reports. So the director's report is one of the first things you'll see in the annual reports. So you'll have a chairman's statement, then you'll have the actual director's report, then you'll have an outlook, you'll have them explaining how they've done, and so on and so on. So it could look like a bit messy at the start, and you might be thinking to yourself, oh my goodness, where do I start with this mess? It's hundreds of pages. Typically, this is probably the easiest thing to read and probably the easiest way to understand annual reports. So as I mentioned, there will be two sides to each annual report depending on how the company did. You'll either have the company give a little presentation and maybe throw in some numbers and say, oh, we did really good here, or we did really poor, and if they hit targets or not. So if they hit targets, then obviously they're going to say we did really good because we did really well. Generally, if they miss, they'll give some bad reason and they'll say, oh, it might be because of economic conditions or so on and so on, which we'll get to in a second. But this is probably the easiest thing to understand with annual reports, and is a way, if you really want to skip the annual reports, you don't want to look at anything, this is probably the quickest way to have a look at it. So there's always two sides. So what are the common things for this year? Well, the first one is obviously COVID. So this obviously affected jobs, this affected industries different. So if you look at travel still hasn't rebounded. Whereas if you look at tech really got a boost and really surged. Same for real estate even. Real estate lately has been surging, but that's also due to low interest rates. The other thing you have is the rising Aussie dollar. Now, this is good for some companies, but it has been bad for most companies. So if you look at even someone like CSL, they've had to hedge much more, and then they've taken more losses because of the rising Aussie dollar. So even though you hear rising Aussie dollar, it's not always good for our Australian companies. So then management will give you an outlook. Now, obviously, you always want your company to flex and be like, oh, we have a great outlook, we're going to do this and we're going to do that. But realistically, there's only a few things that you want to look for. And the first one's better economic conditions. And the second one is higher commodity prices, especially if you're in mining industries. Better economic conditions is pretty straightforward. It's hard for your company to do bad if the economics is pretty good. Then you got the other side. Well, what happens if your company does bad and then you feel like you're running out of time with your investment? Well, once again, there's generally a couple reasons that the company will blame. The first one is there's not enough production, and this could be due to labour, this could be due to economic conditions, this could be a few things. And the second one is legal issues. This, for example, is what's happening with A2 Milk. The last issue is no guidance. Bit questionable whether no guidance is a good thing or a bad thing, but for now we're just going to leave it as neutral. So the next thing is Board of Directors. Board of Directors will start with always management saying, oh, this is how long they've been here for, and they'll make it sound like everyone in management's climbed Everest and they've achieved all these achievements, but that's pretty common sense because they want to take your money. Realistically, they all follow the same spiel. Oh, we've done really well, we've tried really hard this year, thank you so much for your support. Blah, blah, blah. It'll continue somewhere along that line, and then they'll also keep promoting themselves. This is common for every business, but it may sound stupid, but when you look back at it, it makes sense because they want you to invest with the company, right? So even if management's had bad past companies, they're not going to mention, oh, hey, we've just come over from this company. Let's say they come from A2 Milk. They're not going to say, oh, this person's just come from A2 Milk where the share price has dropped 50%, are they? No, because it just sounds bad. So they might mention they came from A2 Milk, but they're not going to mention all the bad stuff that goes with it. So now let's look at an example. So let's say your company grows money on trees, the dream for all companies, right? Well, then it still matters what happens on the outside. Director transactions are a good way to check what management think. So for example, if management are buying up and they think everything's on a discount and you see the percentage of management holdings are increasing, then that may be a sign that you want to get in as well. But this isn't always true. A good example of a company is Woodside Petroleum. So management have got buy orders, if you look for the past 2 years, a transaction of over $30 on average. But then you have the other side. What if management are selling? And this is where A2 Milk's currently in trouble because management sold quite a lot of shares before they put out their results and the downgrades in the stock since tank. So this is not good. So we're going to look at three cases. So let's say a good year. Fred, the CEO, gets $30 of pay. Mary, the CFO, gets $20 of pay. And the other directors get $20. You run a pretty simple industrial company. So for this example, we're going to be using the same idea the whole time. You can change this to whatever company you want. The point is that you just run some sort of company that's fairly stable every time, and you can see the difference between a good year, an average year, and a bad year. So for this example, we're going to presume management on a good year make $300. Why is that? Well, just because it makes it easy. So on an average year, $200, on a bad year, it'd be $100. Well, how much does this leave you with? Well, management will make 70, so that leaves you with $230. So $230 for investors is well over half the profit, and you're thinking, well, that's pretty good. So then they can use this to pay out dividends. You've got all sorts of bonuses. So for this illustration, we're just going to use gold bars. So gold bars, because gold's pretty expensive, and it's one of the most expensive illustrations. Words are tough these days, eh? And then we're going to look at an average year. So let's say this year, the company only makes $200. Well, this could be for several reasons. Slower economic conditions, as we mentioned, lower commodity prices, which may be out of their control. So if you look at companies like Woodside Petroleum, that's one of their issues, or Whitehaven Coal, who stuck to the coal prices, not a whole lot they can do. So we'll look at the same thing. Fred pays himself the same, Mary pays herself the same, and the directors still get the same amount. Overall, $70. The company's made $200. So how much do you get out of this? Well, the same maths, 200 minus 70, so $130. So once again, nowhere near as good as the $230 in terms of percentage, but you're still doing okay. You still get over half the profits. So it's not worth complaining, but for example, this is where you may expect dividends. It'd be like a slow sort of growth company. Well, what would happen on a bad year? Well, let's say your company only makes $100, right? And then for this example, we're just going to presume the business is the same, conditions, however, might be worse, and the company pays themselves the exact same thing. Fred gets 30, Mary will end up with 20, and the directors will end up with 20. Well, what do you end up with? A whole $30. And this is where the problem begins. If management pay themselves an insane amount for doing the same job, depending on a good year and a bad year, as an investor, whenever a bad year happens, you can end up with no profits at all. And this is a major issue. And this is quite basically what happened with COVID, is management were paying themselves the same even with the bad year, and they were slashing dividends, which is a major red flag. So on the next thing we're going to look at though is financial statements. Now, financial statements can be confusing, but basically there's three things you need to look at, and you just need to figure out which one you value the most. So to start with, we're going to look at balance sheets. So this is essentially your assets, your liabilities, and equity. Then we're going to look at income statements, which is your revenue, your profit, your loss, earnings per share, that sort of stuff. And the last thing we're going to look at is cash flow statements, which is just how profitable a business is day to day. Now, balancing these up and understanding which one you value more is important. I personally value the income statement the most because that's when you can see really how the business is doing. However, the balance sheet's also really important, and then that ties in directly to the cash flows. So they all mix and match in a way. So what do you want to see with the balance sheet? Well, with the balance sheet, you want cash to be growing and you want liabilities to be decreasing. So if we use this bag of money, for example, every year you want cash to be increasing because let's say they have a bad year, you want some sort of cash piled. Well, how much? Well, you don't want enough to where Japan, for example, if you look at Japan, the companies hoard money and the government's had to try and intervene and to stop this. Why is this a bad thing? Well, it slows down the economy. If you pretend all the companies, instead of spending the money back to grow, are just hoarding it, then you can see that the growth's really going to slow down because no one's investing, especially if the companies aren't investing in themselves. So then, well, what else? Well, then you need to look at the income statement. So let's say the company is using all this money and spending it all. Well, then in the income statement, you might see revenue growth, you might see profit growth. But this is where you need to look at the cash flows and see if operating cash flow is being used properly. So if operating cash flow is positive, then that's essentially free cash the business can use to invest back in itself. So let's say they do a shipping business, they might go from a small shipping container ship to a major one, and then this would be a good use of productive cash flow. And then you would hope you see extra revenue. So as you can see, this all sort of ties in with each other, and you sort of have to read them together. But for the last part, we're going to look at notes. Now, the notes will accompany the financial statements and can seem confusing because there's pages on pages on pages on pages. But realistically, you just need to break notes down into three ways. The first one is it'll explain revenue, and it'll explain profit, and you'll get segment breakdowns. Why is this important? Well, let's say you have someone like Fortescue Metals who deal mainly with iron ore. You also want to know how the other segments are doing. So this is useful in companies like BHP, where they have more than just one major segment. Even Appen, where they have two major businesses. In a segment breakdown, you can see, okay, this company or this business might be doing well, but the second business might be doing poor. So you have to look at why. Is this a short-term issue? So on and so on. The last thing that's important, in a sense, is top 20 shareholders. I don't pay too much attention to this, but this is just where the business will put at the end of an annual report, this is how well we've done, this is what's happened with our shareholders, whether they've bought more shares, whether they've sold more shares of the top shareholders, and what's happened. Overall, this is typically just done between finance companies and business to businesses. This doesn't really concern retail investors, so I wouldn't pay too much attention to it. But yes, hopefully that explains everything on how to understand annual reports from directors' reports, board of directors, financial statements, and a couple extra points that you need to know. Thank you, and have a nice day. Oh, and don't forget to like and subscribe!